The US dollar has lost over 90% of its value in the last century, yet it's still considered the world's strongest currency. Despite inflation and losing its gold backing, many countries still trade in the dollar, and oil is priced in USD. But does a strong dollar actually help the US economy, or would a weaker dollar have more benefits? Let's go. When people talk about a strong dollar, they're usually comparing it to other currencies, like the euro, yen, or yuan. A strong dollar simply means that a dollar has more buying power abroad. It can buy more euros, more goods from China, or more vacations in Europe. A weaker dollar, on the other hand, buys less. It takes more dollars to get the same amount of foreign currency or imported product. But this strength doesn't exist in a vacuum. It's influenced by interest rates, inflation, trade balances, and global demand for the dollar. So who wins when the dollar is strong? A strong dollar on the surface sounds really good, and for some people it is. Cheaper imports. A strong dollar makes it cheaper to buy goods from overseas. That means lower prices for things like electronics, clothing, and furniture. Stronger purchasing power. Americans traveling abroad get more bang for their buck, so those vacations to Europe and Japan just got a little bit more affordable. Foreign investment. A strong, stable dollar attracts foreign capital. Investors see the US as a safe bet, especially during times of global uncertainty. And lower inflation. Since imports are cheaper, a strong dollar can help keep inflation in check, which is one reason the Fed often favors strong dollars during high inflation periods. But it's not always good news. A strong dollar can actually hurt certain sections of the US economy, especially those that rely on exports. When the dollar is strong, US goods become more expensive for foreign buyers. That can hurt American manufacturers, farmers, and exporters. Corporate earnings drop. Big US companies like Apple and Boeing sell globally. A strong dollar means foreign sales bring in less revenue when converted back to dollars. And emerging market struggles. A strong dollar makes it harder for developing countries to repay back dollar-denominated debt. This can lead to economic instability abroad, which eventually loops back to affect global markets, including ours. So while a strong dollar can benefit consumers, it can actually hurt workers in export-heavy industries and cause headaches for American businesses. Now let's flip the script. We know already that a weak dollar means less buying power overseas, but a weak dollar can also have some surprising benefits to the US economy. First off, it boosts exports. US goods become cheaper for foreign buyers, which means more sales for American companies. It helps job growth. Increased demand for exports can translate into more jobs, especially in manufacturing and agriculture. It also encourages tourism. A weak dollar encourages more foreign tourists to come to the United States. Their money goes further here, so it just makes sense to come. And it reduces trade deficits. In theory, a weak dollar lowers imports and raises exports, which can help balance trade over time. But don't get too excited, because again, there are trade-offs. A weaker dollar means more expensive imported goods, which can fuel inflation and lower the buying power of consumers at home. So why does the dollar remain the world's currency reserve, even when it weakens? Well, it's not about economic performance. It's about global systems and power. Oil is priced in dollars, a setup maintained not just by economics, but also by US diplomatic and military influence in the Middle East. As long as oil trades in USD, every country needs dollars. Dollar reserves. Many smaller economies peg their currencies to the dollar, meaning that they must hold US dollars in the reserve to stabilize their own economies. US debt dominance. Countries around the world buy US debt to ensure the stability of their dollar reserves. Even during a crisis like 2008 or 2020, foreign governments rush to purchase US treasuries. That demand gives the US enormous borrowing power with relatively low consequences. And capital flows. During global crisis, investors pull money out of developing economies and move them into safe haven assets like the US dollar. This strengthens the dollar but weakens foreign currencies and asset markets, effectively transferring wealth from developing to developed nations. Well, it depends on who you are, what industries you work in, and what the economy needs at that time. If you're a consumer who likes to buy a lot of imported goods or likes to travel, a strong dollar is great. If you're a manufacturer, farmer, or exporter, you probably prefer a weaker dollar that makes US goods more competitive. If inflation is high, a strong dollar can help cool things off. And if growth is sluggish, a weaker dollar can stimulate demand. Yeah, it's a balancing act, and monetary policy plays a big role. The Federal Reserve doesn't directly target the dollar, but its decisions on interest rates and inflation control heavily influence the dollar's strength. The US dollar's strength isn't just what it can buy, it's about trust. So whether it's strong or weak, the real power comes from confidence in our economy, in our monetary system, and the fact that the dollar will be honored. So that's why, after all of these years, the dollar still rules the global economy. And with that, I'm Evan, and thanks for watching. If you liked what you just saw, then click on the video here. Also, if you haven't, like, subscribe, and hit the bell icon so you don't miss any future videos.